Okay, now listen for a minute. We need to talk about the one thing you're avoiding more than that gym membership you pay for, but never use. Yeah, life insurance. I know. Talking about your own departure feels a little morbid. I get it. But let's look at the science of it, specifically biology. Because unless you're a Turritopsis dohrnii, that's the immortal jellyfish, you can look it up later. Your expiration date is non-negotiable, meaning it's coming, hun. Your insurance auntie loves you, but what I am not gonna do is have you leaving this earth with your face on rest in peace t-shirts and your loved one selling catfish plates to pay for the funeral. You are a legend, honey. And legends leave their families with a trust fund for generational wealth, not a GoFundMe and hoping for the best. So, we're gonna figure out your specific how much number today, and we're gonna do it without needing a PhD in finance. So let's talk about the rule of thumb. And don't worry, we're not gonna get deep in the weeds today. This is just the fast and dirty version. Usually, when people ask me, Auntie, how much do I need? I tell them that the industry gives you a rule of thumb. They say 10 to 15 times your annual income. Think of this like the BMI of insurance. It's just a quick snapshot. If you make $60,000 a year, you're looking at a $600,000 to $900,000 policy. Now, why that much? Because of math and physics. Specifically, the withdrawal rate. If your family invests $900,000 and lives off a conservative 4% interest, they get $36,000 a year without touching the principal. We'll get into why it's important to live off the interest in a different video. Because we all know unexpected events happen, and you may need to pull some of the funds out to cover those emergency expenses. Suffice to say, if you don't have to, just don't touch that principal. Now, back to our regularly scheduled program. The point of that example is that $36,000 is not yacht money, honey. That's barely keeping the lights on and buying the off-brand cereal money. But when you're gone, it's what's going to replace your function in the household economy. The point is that you have to plan for whatever the withdrawal rate might be, because when you're gone, that fund needs to replace your function in the household economy. You know, the finances of it all. Got it? Good. Now we're going to start with Auntie's special, the dime method. Not dime piece, dime method. Because you're not a rule of thumb kind of person. You're special. You have layers, baby. So, grab pen and paper and let's begin. In the dime method, D is for debt. You're going to add up everything you owe that isn't the house. Don't worry, the mortgage is calculated separately. List the credit cards, that car loan for the SUV you just had to have, and those student loans that are older than your children. If you go to the great beyond, we do not want those collectors calling your spouse. We want them paid in full. Next, I is for income replacement. How many years do your kids have until they're 18 or 22? If your youngest is 5, you need to cover at least 13 to 17 years of your salary so your partner doesn't have to take a second job at the 24-hour taco stand just to pay for young Sonia's soccer practice. M is for mortgage. This is the big boy. There is a psychological science of stress. High cortisol levels, that's the stress hormone, literally shrink the brain's memory center. Losing you is enough stress. Don't make them lose the roof over their heads too. Calculate the full payoff amount of the house. Write that down. Lastly, E is for education. Have you seen the price of college lately? It's rising faster than my blood pressure when I see you driving without a seatbelt. If you want your babies to have a post-secondary education, you need to bake that cost in. Now, add these all together and see what you come up with. I know some of you are thinking, Auntie, that's an awfully big number. I mean, I can't afford $1 million policy. Miss me with that nonsense. That's limbic system thinking. That's the lizard part of your brain overreacting. Yes, I said overreacting. Because term life insurance is cheaper than your monthly streaming subscriptions. You're seriously telling me you'll pay $20 a month to watch Stranger Things, but you won't pay $20 a month to make sure your kids are millionaires if you check out early? Check your priorities, hun. You have a prefrontal cortex for a reason. It's okay to use it for some long-term planning. Auntie gives you permission. Bottom line, you are a high-value asset. You are the engine of your family's economy. Protect the engine. Do the dime math tonight, today, right now. Don't make me come over there and look at your bank statements. Auntie loves you. Stay safe, and for heaven's sake, eat some broccoli. It's good for your heart, and it keeps your premiums down. That's a win-win, yes? All right, my smart cookie, you've made it to the end. Yay! And you're probably looking at that big dime number and going, now, Auntie, where do I actually write this down? Great question. It just so happens that Auntie's got you covered. Because I care about you and I want you to be organized, I've put together a completely free printable dime worksheet designed just for you. It's got all the categories we talked about, space to fill in your own specific numbers, and a little spot to see exactly what kind of coverage you need to keep your family financially snug as a bug in a rug. You can grab it right now. Just click the link in the description below this video. Go download it, fill it out, and take that powerful number with you. That's your first real step to peace of mind. And peace of mind, as in knowing you're doing the right thing to keep your family safe when you're no longer here to help them, is what this whole thing is about, right? Now is a good time to go take a look at your mortgage statement. Gather all your stuff together. You got this. Now, go forth and prosper. Auntie will see you in the next one.